Hi, everyone. This is Jason Biark of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. In an environment with higher interest rates, a lot of stagflation, shrinkflation, consumer debt, credit card debt soaring, his new book that is out at a bestseller for personal finance, No Worries, How to Live a Stress-Free Life. Jared Dillian, thank you for joining me again.
Hey, thanks for having me.
For our listeners out there who aren't familiar with Jared's background, he worked on Wall Street for many years. He was a trader at Lehman Brothers. He also has a best-selling book about his experience at Lehman Brothers. But I want to get your thoughts first on the environment that we have with inflation, stagflation, higher taxes, and then all these rate hikes that are into the system right now. Do you think it's going to be very difficult for the average person out there who's thinking of buying your book and trying to fix their personal finances to start saving and investing, maybe set up a side business right now?
Well, the funny thing is that, No Worries was published in January this year, but I wrote two-thirds of it in 2021, in like December of 2021. And this was, inflation was picking up, but it was, nowhere near the peak. And I think if I were to write that book again today, I would probably include a whole chapter on inflation and how to deal with inflation. And there really is no way to deal with inflation. You just bend over. It's the worst thing in the world. Talking about high interest rates and such, it's very hard for this. I mean, this has been well documented. I'm not the first person to say this, but it's very hard for young people to buy a house in this environment. Affordability has just been trashed. Home prices have gone up 30, 40% since 2021. Interest rates have gone from 2.5 to 7 on a 30-year fixed. So buying a house has become prohibitively expensive for a lot of people. And, the way I look at this is um, I don't think that we're going to have a significant pullback in residential real estate. I don't think that's going to happen, partly because of the level of immigration that we're getting. I think that's one reason. So, if you're 27 years old and you're thinking about buying a house and it's going to cost you substantially all of your savings for the down payment, and then you're going to have, you're going to be paying 40% of your income to mortgage insurance and property taxes. I still think that's probably the right thing to do, even at these levels of affordability. I think housing prices will continue to go up over time, and that's a little bit of a contrarian view. A lot of people expected that house prices would go down when interest rates went up. It hasn't happened. They've kind of leveled out a little bit, but I don't think they're going any lower.
It's pretty complicated because in a lot of different states, the government makes it very difficult to get the permits to knock down an old house and build a new house, especially in states like California. But the cost, so the replacement costs, if you're going to knock down, say, an old house that was built post World War II and build a new house, I mean, the replacement costs are enormously higher compared to 5, 10, 15 years ago. So the costs are going up. So just because it's supply and demand, like I hear people saying that, like, oh, there's going to be too much supply soon, but there's also the cost rising for a lot of the home builders for a lot of the material costs, and then you add in higher interest rates. I mean, the mortgages in a major city or metro area for a small condo or a small starter home, you're looking at over $4,000 a month in many major cities or metro areas.
Yeah, I mean, I'm very familiar with this. I just built a house. I'm recording this podcast from the house that I built, and I got to see this firsthand. Every piece of wood, every nail, every cabinet, every toilet, everything that went into this house, plus a 12% fee to the builder, resulted in, me paying whatever for the house. Like it is really a sum of the parts valuation. So, I'm very familiar with this.
Was the cost up a lot in the last couple of years? So did you price this out like a couple of years ago and say, hey, now it's like 25, 30% higher than you thought?
That didn't work out that way. It worked out for the better. We started building after the big run up in lumber prices. So lumber prices had already come down. So we kind of missed that. So we didn't really get hosed by the cost increases. The house did go over budget, but it was mostly because we wanted some finishes that were a little more expensive than what was in the budget. So
So the normal personal finance advice from like a Susie Orman or Dave Ramsey is to start cutting your expenses, pinch pennies. But in an environment like you described, an inflationary environment, stagflation, shrinkflation, and people's like food bill, grocery bill, insurance, all the everyday living expense bills are going up. It doesn't seem like just cutting expenses is going to cut it. We're seeing in the jobs reports that people are adding a second or third job, part-time job like crazy. That chart on the Federal Reserve Bank website is going parabolic. So do you think then that people can grow their income in an inflationary environment, or do you think it's going to be very difficult?
I mean, so both it's difficult and you still can. So, it's funny. For lunch today, I had a can of soup. And the soup I bought yesterday at Publix in Pawleys Island, it's a can of Progresso soup. It was $3.09. I remember, I think it was when I was living in New York, in New Jersey, and there was a Pathmark, and I was buying soup for like 69 or 79 cents a can. So over the last 15, 20 years, you're seeing 4x increases in stuff. It's absolutely incredible. You can still win. You can still build savings, and what the statistic you gave about people getting part-time jobs. I mean, actually, that is people behaving rationally and doing the right thing. That's actually good to hear. I wasn't aware of that statistic because if your budget is getting squeezed by inflation and it becomes very difficult to cut costs on stuff, almost impossible, then really the only solution is to go out and make more income. So that's just rational behavior.
Yeah, I agree. And if people aren't going to hire you for another part-time job, let's say you can't fit it into your schedule or you actually want to sleep, you're going to have to be creative. You're going to have to hustle. Maybe you create a job for yourself and develop a side hustle business or something like that, or with friends or family members, come up with a catering business on the weekend or some type of online selling business or something like that for some extra cash.
Mm-hmm. Yep.
So, do you see any industries where entrepreneurship side hustles you think would benefit in an environment like this?
Uh, well, you kind of put me on the spot. I never really thought about this before. Um, retail is kind of a pass-through business. Inflation gets passed along. There is pricing power. If you have a business where you're selling handmade jewelry on Etsy, you definitely have pricing power. You can raise prices. It really comes down to places where you have pricing power. Funny thing is that I work in a business that doesn't have pricing power. Like it's probably the worst in the world for pricing power. And I'm talking about investment research. I'm talking about newsletters. Like, demand for research at this particular point in time is actually very soft. And it's even though there's been a lot of inflation, I don't have the ability to raise prices. So, my newsletter costs $795. When I started 16 years ago, it cost $600. If the price of the newsletter kept up with inflation, it would be about $1,000. But like I said, I just don't have the ability to raise prices.
Yeah, that's true. I've worked in the newsletter industry and I'm kind of doing that with my Patreon right now. I've debated raising prices as well. Actually, that question I put you on the spot with, I asked our mutual friend Carol Roth the same question since she has a book out on entrepreneurship. And she said because of the asset price inflation, right? How home prices are still high, stocks are still high, and how the rich don't, a lot of their salaries aren't relying on variable interest rate debt with like a mortgage debt or a credit card debt. She said, develop a business where you can save time or money for rich people. That's what she said.
I know Carol, and that's she's 100% correct for sure. Yeah.
Yeah, and that's why you're seeing private jets with dogs, a dog airline now.
We
For
need a
six
private
thousand
cat for cats.
for cats? Oh,
Yeah.
I don't know about that one. Will they sit? Will they sit still? Cat herding. Okay, so do you think then with all this inflation, and it's not just here in the United States, I would argue that inflation is actually worse outside the United States. Do you think that that's one of the major reasons why the gold price and gold demand is so high in like China, India, Japan, Korea, and other emerging markets right now?
Well, I think it's two things. I think it's that. I think you're correct on that. Also, but I think the bigger factor in the price of gold going up has been central banks buying. Um, China in particular, they bought a lot, but a whole bunch of other central banks too. And this started in the beginning of the Ukraine war when U.S. placed sanctions on Russia and basically seized all their assets. And countries around the world saw this and said, "Well, we don't want to get on the wrong side of the United States, or if we do, we don't want our assets to get seized. So let's buy gold and hold it domestically where it's unseizable." So I think that's probably worth 2/3 of the run up in the price of gold. And I think probably the rest of it is retail demand out of Asia, like you described. So
And do you also think that a bond bear market, a long-term bond bear market, maybe in government bonds, not just U.S. Treasury debt, where I think there's a supply and demand issue that's developing, how foreigners are not going to, like you said, with the Russia sanctions, there's not going to be as much foreign demand for U.S. Treasury debt compared to the past. So do you think then that a bond bear market would also be good for gold?
yes, I do actually. That's a very insightful question. The conventional wisdom is that high interest rates are bad for gold because gold doesn't have any interest. And if you have a 10-year note that yields 6% and gold which yields nothing, then the 10-year note is more attractive, right? So that's the conventional wisdom on interest rates and gold. But I think the dynamic has changed, right? Because basically, let's say Biden wins and the Democrats take the House and the Senate, and we go into a recession and we're running $4 trillion deficits next year. 10-year interest rates are going to go to 5, 6, 7% maybe. And what's going to happen is that increases the likelihood that at some point the debt will be monetized. And I'll take a second to explain what I mean. With 10-year interest rates at 7%, the economy will not be able to withstand it. And there will be pressure by the government to the central bank to cap interest rates by purchasing an unlimited amount of bonds at a certain interest rate with printed money. And that is the point at which gold goes parabolic. So, what you've actually seen a pickup in correlation between interest rates and gold. It used to be a negative correlation. Now it's a positive correlation. It's very interesting.
I think we had a similar correlation in the 1970s, but there was a Paul Volcker back then, and the US's national debt wasn't nearly as high. And the US, I think, was still a creditor nation for a lot of the 70s back then. So Volcker could raise the interest rates higher and higher and higher to strengthen the dollar and kind of save the dollar. And that kind of stopped the gold price from going up. But I think we're not there. Mathematically, there's no possibility of a Paul Volcker at this point. I mean, if they keep raising interest rates to a certain level, like the U.S. government's not going to afford the interest payments on the debt.
Yeah, that's actually very insightful. So when Jimmy Carter was president in the late 70s, the debt to GDP was about 30%. And now it's about 130%. So like you said, we're kind of trapped. Even if we wanted to, if inflation got out of control, even if we wanted to hike interest rates to double digits, we can't do it because then the government would be insolvent. So
So do you think then the strategy for not just the US, maybe like Japan, European Union, a lot of these other countries is to start cutting interest rates on the debt and monetize the debt, that we're going to see like a global bond bear market for government bonds soon? And so that's why gold demand in a lot of these other countries is starting to pick up, because a lot of these people are starting to realize that these governments, they can't afford high interest rates, and they're going to either start cutting rates or monetizing debt then.
I don't think most people are that sophisticated. I really don't. I don't think most people, I mean, you and I are pretty sophisticated. We're talking really about the ins and outs of how monetization works and stuff like that. I don't think most people know that. I think they just instinctively buy gold when they see, deficits going up a lot. Um, so yeah, yeah, pretty much.
I want to transition now to your experience on Wall Street, working at Lehman Brothers and at banks. Do the banks make enormous profits buying and selling bonds and derivatives?
Oh, absolutely. I don't remember what I'm going to guess at Lehman, the fixed income division probably had revenues of $6 to $8 billion a year. It was a huge business. Yeah.
So, in an environment like this with a bond bear market, do you think that's really going to hurt a lot of the largest, some of the largest profits for some of these banks then?
It really depends on the shape of the yield curve. With the yield curve inverted, that really it becomes difficult to carry positions. It becomes difficult to carry inventory. If we get a positive sloping yield curve, then you can just hold bonds, you can hold inventory and ride down the curve. So look, banks can make money even in a bond bear market, but it just helps a lot if you have a normal yield curve.
Oh, that's interesting. But don't a lot of these investment banks, especially prior to the 2008 financial crisis, didn't they start to leverage up their bond trades? Like they started borrowing in the repo market and then putting on like these leveraged bond trades or selling volatility. So it's not just a pure like buying and selling bonds. I mean, like some of them are leveraging up a lot.
Um, yeah, I mean, look, I mean that could be true. I'm 16 years out of the banking world, so I don't really know what they're up to these days, but for sure that could be true.
Oh, because I was gonna ask because yesterday there was a Japanese bank and it looks like they got similar problems to Silicon Valley Bank with their interest expenses and the strong dollar and the weak yen. So they look like they have a lot of problems now.
Yeah, I saw that story going around as well, and I didn't really dig into it.
So in this environment, how to live a stress-free financial life, you think then that people are going to have to constantly update their strategy to try to beat inflation, that they can't set anything in stone, then it's going to be just too difficult?
Yeah, I think I don't think Americans really have an appreciation for the types of things that happen in an economy when it is plagued by high inflation. Like you really should go to Argentina and talk to some of the people there and some of the things that people do to combat high inflation. Like for example, people in Argentina, they get a paycheck and they go out and buy a washing machine or a TV or a dishwasher. Like that's the first thing they do before the money loses any of its value. It's a tangible good. It's worth something. They can trade it for something else. It's just a massive rush to get out of paper currency into hard assets.
Yeah, exactly. Or they would convert in the black market money changers, because not through official government banks or any of those exchanges, because the exchange rate was rigged. But they'd go and they'd convert to U.S. dollars because the inflation rate for U.S. dollars would be way lower than the inflation rate for Argentinian pesos for many, many years.
Yeah, I was actually in Argentina in 17 or 18, I can't remember. And the exchange rate was 20 pesos to the dollar at the time, and the black market rate was about 24. Anybody who bought dollars at 24 is very happy right now, right? And anybody who has bought dollars at any point up until Malay got elected is pretty happy.
Was Argentina starting to use Bitcoin a lot back then? Because I'm hearing like a lot of emerging market demand in Latin America and Turkey. There's a lot of people starting to use Bitcoin now because they don't trust like the emerging market currencies.
That was not a thing back then. It probably is now, but it wasn't a thing back then.
Do you think that people can save in Bitcoin, or do you think that Bitcoin's mostly for speculation?
Well, I think from a practical standpoint, it's mostly for speculation. It doesn't have to be, but in order for something to truly be a store of value, it has to have pretty low volatility, right? So Bitcoin has volatility of about 70 or something like that. Um, like it makes it really unsuitable for holding as a store of value. I mean, people try to do it, but it's tough.
So, in terms of asset classes, you think that people should avoid bonds for right now because if what the inflation rate does stay higher, governments start monetizing debt, you think that the worst asset class probably could be either government bonds or private sector, maybe with some of these that are tied to real estate, commercial real estate?
I actually have a more nuanced view on that. And also keep in mind I'm a trader, so I tend to focus more on the short term than the long term sometimes. Um, I actually think in the short term, bonds are probably going to do reasonably well. We've gotten a pretty good run of soft economic data right up until today. We had claims number and housing starts and building permits and jolts and Chicago PMI and last week's claims number. We've had a pretty good run of crappy economic data. So I think the economy is slowing down. We may tip into a recession. Really, like if you look out until November, I would actually be long treasuries, and then whatever happens after the election is going to change everything. So
Yeah, I mean, right now the budget deficits are pretty large, but depending upon who wins the election, it could get even larger.
yeah, that's absolutely true. I mean, I think Trump is not a small government type by any stretch of the imagination, but he's significantly more small government than Biden. So if you figure Trump gets elected, maybe, and it's probably bullish rates. It probably is. So
I mean, Trump's policies, he hires most of the supply siders here in the DC metro area, like Steve Moore and Art Laffer and those guys. So those guys aren't free market either. Like they do tax cuts, but they're like targeted. So I think the last Trump tax cuts, I think it was between like 75,000 and 450,000 a year. I think that was the salary range for the targeted tax cut. So it didn't benefit everyone, but he didn't really cut the size of government like you said. So it was okay, yeah, you got a tax cut, selective groups got a tax cut. The government, like government spending was drastically cut. I think it wasn't the budget deficits, they were still around a trillion, I think, under Trump.
they're about a trillion. Yeah, yeah.
It's like the new normal. It's like we've gotten desensitized now. It's like, oh, the budget deficits were only a trillion back then.
Well, a trillion. I mean, a trillion is about 4% of GDP, which is a little high, but is actually not that bad. Um, Really, what you need to do is to get the deficit down to about 2% of GDP. And then if we can grow the economy at 3% a year, we'll chip into that debt over time. A lot of people think you have to balance the budget or run a surplus. And while that's good, well, I think that's an admirable goal. Really, all you need to do is run a deficit of about 2% of GDP.
What industries do you think could have a bull market or a lot of investment or new jobs or higher paying salaries for that type of growth, for that type of GDP growth then?
I have no idea. I have no idea.
Yeah, I think the people in DC who are spending lots of money don't have any idea either. Because everyone's talking about what artificial intelligence, and there's only a couple of products, right? There's a premium for Chat GPT, but I think most of the data centers and the artificial intelligence investments, a lot of them are unprofitable, or the data centers that everyone's talking about haven't even been built yet.
Hmm. Yeah.
Does this remind you this of the tech bubble? What people are talking about with artificial intelligence and the Nvidia stock? Are you reminded of the tech bubble?
Yeah. So I basically started my career in the tech bubble. I started working on Wall Street in 1999. So I got to see basically the last year of it. And then I got to see the entire unwind. A lot of echoes, but what's really interesting about the market this time around, it's like the whole .com bubble is rolled up into one stock, right? Like back in the .com bubble, you had all this crap. You had like 8x8 and mama.com and like all these crazy little .coms that were trading at like 500 P's and stuff, or like had, no cash. And really today, all of that speculation is in one stock, Nvidia. And it's really a weird phenomenon. Like I've never, like never seen anything like this before.
Yeah, I agree. Or it's in S&P 500 futures, like the index. So with passive investing, so the index fund bubble, because it seems like there's huge flow of funds into like the Nasdaq 100 and the S&P 500, or a few other of the Mag 7 tech stocks, like Apple. I mean, Apple in the last month, I think they added another $1 trillion of market cap when their earnings were bad.
Yeah, yeah, yeah. A lot of valuation expansion. I will say that, most stocks are not super expensive. If you look at the S&P 500 X Tech, stuff is trading at about an 18 multiple, which is about the long-term average. So it's not as if the entire market is overvalued. It's funny. I didn't dig into the stock market today, but the Dow was up, the S&P was down, the Nasdaq was down, was even more. Um, if this unwinds, you could actually have a big style box trade where large cap growth gets crushed and small cap value rallies, kind of like we did in 2002, 2003, 2004.
I think the market cap for the Mag 7 right now, I think it's 15 trillion, give or take. So it's larger than the stock market, the market capitalization of most of the other stock markets in the entire world. That's how insanely large the Mag 7 market cap is.
Yep.
Yeah, it's just shocking. It seems like a lot of extra capital maybe over the last couple of years has just flowed into those tech stocks specifically.
I mean, yeah, without a doubt.
I want to thank you so much for your time today, Jared. If my listeners want to take a look at your book, how do they do so?
Yeah, the book is No Worries: How to Live a Stress-Free Financial Life. It's on Amazon, it's in Barnes and Noble, it's pretty much anywhere. It's a great book. It's got 514 4.8 5-star reviews on Amazon. By the way, I do have another book coming out in October, which is nothing to do with finance. It's a short story collection. It's called Night Moves. So be on the lookout for that in October.
And you also have your daily Dirt Nap newsletter and that report you talked about, which expands on Harry Brown's permanent portfolio, excuse me, which expands on Harry Brown's permanent portfolio book that you went even more in depth on some of the other asset classes like real estate, I think. And you were talking about that in our last interview.
Yes, yes. There actually is. I'm in the process of working on an awesome portfolio book, which I hope will come out in 2026. So I am working on that.
Excellent. And is it going to include commodities investments into there too as inflation hedges?
Oh, absolutely. You know it.
Very good. Thank you so much for your time. I really enjoyed it.
Thanks, Jason.